Bitcoin has just run into a wall, and the timing could not be worse. Right now, Bitcoin is sitting near $64,000, still trying to recover the $65,500 high it touched over the weekend. And while it struggles to hold that ground, something bigger is approaching. Tomorrow morning at 8:30 Eastern Time, the United States releases its July inflation report. One number. And that number could quietly decide what happens to every risk asset on the planet for the next several weeks. Here's what makes this dangerous. Bitcoin may already be positioned for a violent move before that number even prints. If inflation comes in hotter than expected, the market could start pricing out future rate cuts within minutes, and Bitcoin could discover exactly how much hidden leverage is sitting underneath this rally. But if inflation comes in cooler, something completely different could happen. Something most traders watching the price alone will completely miss. Because there is one signal underneath Bitcoin right now that could determine whether tomorrow becomes a breakdown or a breakout. And we're going to get to that signal in a few minutes. Quick note before we go further. This video is for informational and educational purposes only. Nothing here is financial advice, and you should always do your own research before making any decisions with your money. Morning, afternoon, or night for you right now. Drop it in the comments before we start. I always like seeing where this channel actually reaches. Now, let's talk about why the price chart alone is lying to you. If you only look at Bitcoin's chart today, here's what you'd see. A rejection near 65,500. A slide back towards 64,000. Momentum that's clearly cooling off after last week's push higher. On the surface, that looks like a normal pullback. Nothing dramatic. But that's the mistake. Looking at Bitcoin's chart and thinking this is simply a Bitcoin story. It isn't. This is a story about Bitcoin and inflation and Treasury yields and Federal Reserve expectations and liquidity and how all of those things move together like dominoes. Tomorrow's inflation print doesn't just tell you whether prices went up or down last month. It tells the market whether the Federal Reserve is closer to cutting interest rates again or further away from it. And that single expectation shift can ripple through the dollar, through bond yields, and straight into Bitcoin's order book within the first 60 seconds of the release. Once you understand that chain, tomorrow's number suddenly looks a lot more dangerous than a routine data point. Think about how many separate markets actually sit between a single inflation report and Bitcoin's price. The bond market has to digest it first. The currency market reacts to whatever the bond market just did. Equity traders adjust their own risk models based on both of those moves. And only after all of that does crypto typically get its turn. By the time Bitcoin actually reacts, it's often responding to 3 or 4 other markets that already moved first, not to the inflation number directly. That lag is exactly why the first candle after the release can be misleading, and why so many traders end up chasing a move that's already partly over before they even click buy or sell. And here's the part that should really get your attention. Last month's inflation report actually came in soft. The headline number rose 3.5% year over year, well below what economists had forecast, and a meaningful drop from the month before. That's disinflation. That's normally bullish, and yet Bitcoin still isn't back above its recent highs. So ask yourself, if soft inflation didn't push Bitcoin higher, what happens if tomorrow's number surprises the other way? Hold that thought. We're coming back to it. Let's build the chain properly because this is the part almost nobody explains clearly. When inflation comes in, hotter than expected, here's the sequence that tends to follow. Inflation fears rise. Traders start pricing in fewer interest rate cuts from the Federal Reserve. Treasury yields tend to climb. The dollar typically strengthens. Financial conditions get tighter. And risk assets, Bitcoin included, tend to come under pressure. Now reverse it. When inflation comes in cooler than expected, rate cut expectations usually strengthen. Yields can fall. The liquidity outlook improves, risk appetite increases, and Bitcoin gets room to rally. That's the textbook version. Except there's a problem with the textbook version. Markets don't trade the number itself. Markets trade the difference between the number and what everyone was already expecting. A 3% inflation print can crush a market if traders were expecting 2.5%. That exact same 3% print can spark a rally if traders were bracing for 3.5%. It's never about the headline. It's about the surprise. And right now, expectations are genuinely split, which is exactly why tomorrow carries so much weight. Let's walk through 3 scenarios because this is where the real fear of missing the move should start to set in. Scenario 1, a hot print. Inflation comes in above forecast. Treasury yields likely rise. The dollar likely strengthens. Rate cut expectations weaken. Bitcoin sells off, and leveraged long positions start getting liquidated, adding fuel to the drop. But that isn't necessarily where the story ends. If the market has already been bracing for a hot number, defensive positioning could mean the sell-off is sharp but short-lived. Scenario 2, a cool print. Yields decline. Rate cut expectations increase. Risk assets strengthen. Bitcoin has a real shot at breaking back above resistance. But there's a trap here too. If Bitcoin is already carrying heavy leverage into the release, the first move up can attract a wave of new longs, get overextended within hours, and violently reverse. Scenario 3. The print basically matches expectations. This is the one almost nobody prepares for, and it might be the most interesting outcome of all. Because when there's no surprise in the data, positioning takes over as the real catalyst. And scenario number 3 could produce the most violent move of the entire week. We're going to come back to exactly why that happens. But first, we need to talk about the mechanism that turns a small surprise into a giant one. This is where Bitcoin stops behaving like a normal macro asset and starts behaving like something closer to a pressure cooker. Underneath every price move sits a layer of derivatives activity most casual viewers never see. Open interest, perpetual futures, funding rates. And when price moves sharply in one direction, over-leveraged positions on the wrong side start getting forcibly closed out. That's called a liquidation cascade, and it can turn a modest 1% move into a 5 or 6% move within minutes. Here's the sequence. A small inflation surprise creates an initial Bitcoin move. That move triggers the first wave of liquidations. Those liquidations force additional buying or selling into the market, regardless of what any trader actually wants to do. And that forced flow accelerates the original move far beyond what the inflation data alone would justify. The first move you see tomorrow morning may have almost nothing to do with where Bitcoin ultimately settles by the end of the day. That's the trap most retail traders fall into. They see the first candle and they react to it immediately, without realizing the first candle is often just leverage clearing itself out, not the market's real verdict. Think of it like a crowded room where everyone suddenly tries to leave through the same exit at once. It doesn't matter whether the original alarm was minor. Once the rush starts, the rush itself becomes the story. That's what a liquidation cascade actually is. It's not new information entering the market. It's old positions being forcibly unwound, all at the same time, regardless of what anyone still holding Bitcoin actually believes about its long-term value. And because Bitcoin trades continuously, 24 hours a day, 7 days a week, these cascades can happen at 3 in the morning, just as easily as they happen during the inflation release itself, which is exactly why so many traders wake up to a completely different price than the one they fell asleep watching. If this is starting to click for you, hit like right now. It genuinely helps this video reach more people who need to understand this before tomorrow morning. Let's get specific about where Bitcoin actually sits right now. Bitcoin spent the weekend pushing up towards $65,500. Then slipped back under $64,000 after tension around the Strait of Hormuz rattled risk assets broadly, not just crypto. That pullback wiped out essentially all of the weekend's gains in a single session. The market is currently treating the zone between $64,000 and $66,000 like a battlefield. Buyers have repeatedly tried to defend the lower end of that range. Sellers keep showing up whenever price approaches the top of it. In the broader macro backdrop, oil spiking on geopolitical risk, a Senate crypto bill getting pushed off until fall, corporate holders trimming positions, has kept a lid on any decisive breakout. Zooming out further, many traders are watching the 60,000 to 65,000 region as the larger macro floor for this entire cycle. If Bitcoin can keep defending that zone while eventually clearing resistance above it, some analysts believe this consolidation could become the base for a much bigger move going into next year. But technical levels only matter because real money and real leverage is sitting around them. That brings us to something that should be bullish, and yet somehow isn't translating into higher prices. Yet. Here's where Bitcoin gets genuinely strange. Spot Bitcoin ETFs pulled in roughly $850 million in net inflows during the first week of August alone. That's serious institutional demand. Real money flowing in on a weekly basis. And yet Bitcoin still can't decisively clear its resistance zone. So ask yourself the obvious question. If institutions are still buying, why can't Bitcoin simply break higher? There are a few possible explanations. Existing large holders may be selling into that institutional demand rather than adding to it. One major corporate holder has offloaded well over $400 million worth of Bitcoin so far this year, even while still holding more than 840,000 coins overall. Some of the ETF flow may be getting offset by options hedging or derivatives positioning behind the scenes, and some of it may simply be rotation, capital moving between Bitcoin and other assets, rather than fresh money entering the system. The answer to why Bitcoin can't break out despite strong ETF demand may be sitting somewhere most retail traders aren't even watching. There's also a quieter possibility worth naming directly. Some of that ETF demand isn't new money entering crypto at all. It's existing Bitcoin holders moving their coins from self-custody or exchange accounts into a regulated ETF wrapper for tax reasons, estate planning, or simple convenience. On paper, that shows up as an inflow. In reality, it doesn't add a single new dollar of buying pressure to the market. Separating real new demand from this kind of internal reshuffling is genuinely difficult from the outside, And it's one of the reasons headline ETF flow numbers can look impressive while the price action underneath tells a much more hesitant story. Are you positioned for this, or are you just watching from the sidelines? Comment below and let me know honestly. Now let's zoom all the way out, because Bitcoin does not trade in isolation. It never has. The market is constantly comparing Bitcoin's potential return against the return available on safer assets like cash and Treasury bonds. That comparison runs through something called real yields, which is essentially the interest rate you earn after accounting for inflation. When yields rise, the opportunity cost of holding a non-yielding asset like Bitcoin becomes more significant, and that can pressure the price. When yields fall, the liquidity environment tends to become dramatically friendlier for assets like Bitcoin. Here's the chain worth remembering. Bitcoin responds to the 10-year Treasury yield. The 10-year Treasury yield responds to the dollar index. The dollar index responds to shifting expectations about the Federal Reserve's next move. And tomorrow's inflation report could hit all four of those dominoes within the same 60-second window. This is exactly why this matters right now, more than almost any other data release this quarter. Here's the part that trips up even experienced traders. The inflation number doesn't directly move Bitcoin. The Federal Reserve's reaction to that number does. And the Fed doesn't simply ask whether inflation is high. It asks a more complicated set of questions. Is inflation actually falling, or just holding steady? Is the labor market weakening underneath the surface? Are financial conditions already tightening on their own? Is this inflation sticky or temporary? And is another rate cut genuinely justified by the broader picture, not just one data point? That means a single inflation print can shift expectations without automatically determining what the Fed actually does next. And that gap between what the market assumes and what the Fed eventually decides is exactly why tomorrow could get completely misread in real time. This is where things start to break down for traders who only watch the headline number and react instantly. It's worth remembering that the Fed doesn't make decisions based on a single month of data, no matter how dramatic the 1 month looks in isolation. They're weighing a trend built from several months of readings, alongside employment figures, wage growth, and broader financial conditions that develop over time. One hot or cool print can shift the probabilities the market assigns to a future rate decision, but it rarely flips the Fed's actual policy stance overnight. The danger is that markets often trade as if a single data point settles the question, when in reality it only adjusts the odds slightly. That mismatch between how traders react and how the Fed actually behaves is where a lot of the tomorrow's volatility could come from. Let's put all of this together into three clear outcomes. If the print comes in hot, expect Bitcoin downside as yields rise and rate cut expectations weaken. But if the market has already positioned defensively into the release, that sell-off could be surprisingly short-lived. If the print comes in cool, expect Bitcoin upside as yields ease and liquidity expectations improve. But if Bitcoin is already carrying heavy leverage, that first move up could reverse violently within hours. And if the print lands almost exactly in line with expectations, that's the wild card. No surprise, it sounds boring on paper. In crypto, it can be the most explosive outcome of the three, because positioning itself becomes the catalyst instead of the data. Let's walk through exactly how that third scenario could unfold, because this is the part almost nobody is talking about right now. Imagine tomorrow arrives. The inflation print lands almost exactly where economists expected. Bitcoin barely moves in the first few minutes. Traders relax. Commentary calls it a non-event. Then, later in the session, Bitcoin suddenly breaks out of its range. Here's why that can happen even without a surprise in the data. Stop-loss orders and pending buy orders tend to accumulate just above resistance and just below support. When price finally pushes through one of those levels, even for a technical reason unrelated to the inflation print itself, it triggers those orders automatically. Short sellers get trapped and are forced to buy back their positions to limit losses. That buying pressure attracts algorithmic trading systems designed to chase momentum. And within minutes, a quiet, uneventful day turns into one of the sharpest moves of the month. The same mechanism works in reverse. If support breaks instead, stop orders cascade downward. Forced selling accelerates, and the drop can outrun anything the actual news justified. That's why the level itself matters less than what's sitting behind the level. The price is just the trigger. The real fuel is the leverage waiting on both sides of it. Now here's the part nobody's paying attention to. That trap can spring regardless of which direction the inflation print surprises in. The setup exists right now, today, before we even know tomorrow's number. So what should you actually be watching tomorrow beyond the headline price? Watch how the inflation print compares to consensus expectations, not just whether it rose or fell. Watch the 10-year Treasury yields reaction in the minutes after release. Watch the dollar index for confirmation or divergence. Watch Bitcoin's first 15 to 30-minute response specifically, since that window tends to reveal the market's initial red. Watch trading volume, because a move on thin volume means much less than a move on heavy volume. And watch open interest in Bitcoin derivatives, since a spike there often signals fresh leverage entering rather than existing positions simply closing out. Here's a useful shortcut. If Bitcoin rises while yields are also rising, that's an interesting divergence worth digging into. If Bitcoin falls while yields are also falling, that's interesting too. Those divergences often reveal underlying demand or supply that the headline number alone won't show you. Zoom out even further, because this isn't really about one Wednesday inflation report. The bigger question is whether Bitcoin is quietly transitioning from a purely speculative, retail-driven trade into something closer to a macro asset, one increasingly influenced by institutional capital, ETF flows, and traditional financial plumbing rather than retail sentiment alone. That transition, if it's really happening, creates a completely different kind of market, because macro assets don't necessarily move when everyone expects them to. They move when positioning, liquidity, and expectations all line up at once, sometimes with almost no warning. Do you think this system can hold together as more institutional money flows in? Or does that create new kinds of fragility we haven't seen before in this market? That's genuinely worth sitting with. Subscribe if you want to stay ahead of shifts like this one, because they tend to show up in the data long before they show up in the headlines. So what actually happens tomorrow? I'm not going to hand you a price prediction, because anyone who tells you they know the exact number is guessing. What I can give you is the framework to read it in real time, faster than most of the market around you. Here's what bullish confirmation looks like. Inflation comes in softer than expected. Yields fall. The dollar weakens. Bitcoin clears resistance. Volume expands to confirm the move. And open interest rises steadily without an immediate spike that signals excess leverage piling in too fast. Here's what bearish confirmation looks like. Inflation comes in hotter than expected. Yields spike. The dollar strengthens. Bitcoin loses its support zone. And long liquidations start accelerating the drop. And here's the dangerous fake out. The initial move goes one direction. The broader macro confirmation, yields, dollar, doesn't follow through in the same direction. Bitcoin reverses. And leverage accelerates that second move far more violently than the first one. That third scenario, the fake out, is the one I'd be watching most carefully of all. Bitcoin has spent weeks trying to convince the market that its next major move is coming. Tomorrow may finally tell us whether that move is real or whether it's still further away than the price action suggests. If Bitcoin breaks this wall with the macro backdrop moving in its favor, cooler inflation, falling yields, a softer dollar, the market will have to seriously reconsider how much real demand is waiting underneath this consolidation. But if inflation comes in hot, yields surge, and Bitcoin loses its current range in response, the market may discover that the support everyone assumed was solid was never quite as strong as it looked on the chart. So don't watch Bitcoin's price alone tomorrow morning. Watch the inflation surprise relative to expectations. Watch Treasury yields. Watch the dollar. Watch the leverage building up in the derivatives market. And most importantly, watch what Bitcoin does after its first reaction, not just the first reaction itself. Because the first move could be the trap, and the second move could be the real one. What would you actually do if this plays out the way I just described? Would you be ready to act? Or would you be reacting a step behind everyone else? If you want the macro picture behind Bitcoin, not just another price prediction video, this is exactly what this channel is built around. And if any part of this finally made the bigger picture click for you tonight, do me a favor and drop the word macro in the comments below. I'm genuinely using that to gauge which topics to go deeper on next, so it's not just a throwaway line. It actually shapes what I build next. Share this with someone who's been trading Bitcoin off the price chart alone without watching what's actually driving it underneath. Tomorrow, that difference could matter more than usual, because the biggest Bitcoin moves rarely begin on the Bitcoin chart. They begin somewhere else,